Hello there, everyone, and welcome to The Final Bar. It's Wednesday, August 14th. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in a sunny but comfortable Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis and the power of the StockCharts platform. Another nice sort of recovery day for stocks. The major averages all finishing slightly into quite a bit in the green. As we have, further upside relative to or related to inflation data. Yesterday on Tuesday's session, it was the PPI number. Today, the CPI number. Both of those, generally speaking, coming out in line with expectations. But that's enough for the market to show renewed optimism about the Fed's ability to sort of navigate this Goldilocks landing, to create a soft landing, as it were, and rotate very beautifully, very seamlessly from a period of steadily higher rates to a rate cut cycle for the first time in quite some time. Market pricing in, obviously, a cut at the September meeting, still quite a bit in flux between a 25 basis point cut and a 50 basis point cut. It's one of those things we'll look at as we get into our market recap. Let's look at the major averages here as we're trying to make sense of things. I would say, generally speaking, slightly higher is the way I would describe the major market averages today. The S&P 500 finished the day around 54.55. That's up 0.4%. The NASDAQ spent much of the day below the zero level, but did finish just slightly in the green, just below 17,200. And the Dow did close back above 40,000 today, and that's up 0.6% from yesterday. So we're back to a somewhat of an unfamiliar pattern, although it has perked up here at times in the month of July. Dow up more than the S&P, NASDAQ up less than the S&P. Mid caps, small caps, both in the red. The small cap S&P 600 down 0.4%. The VIX down another almost full 2 VIX points lower to 16. And, I was having a conversation with Dale Pinkert of Forex Analytics. So shout out to the guys at Forex Analytics. Great group, Blake and Dale and others. I was on their Face interview, which is their pre-open show every morning. And had a lot of fun talking about a lot of different themes. One of the things we talk about is just the VIX. I mean, the unusual activity we've seen in the VIX. I mean, it really is unprecedented in terms of the peaks, the height to which the VIX was in the last 2 weeks. I mean, above 65. I mean, and again, it's only a handful of times, going back in the last 20 years. There's not many more observations going back in the history of the VIX. And going above 65 in the way that we did and having it not be part of a much broader decline in risk assets, this would literally be unprecedented if we recover from here. So when the VIX spikes above 65, I think two things. Number one, we're probably going to have a pretty painful bear market rally, painful if you're bearish, because it's going to be a big counter trend move that's going to suck a lot of people in. And then most likely we have much more of a downside to be had. As the market was going up, to digress a moment, as the market was going up, and we'll go to a chart of the S&P here, in a rare, intra update or early update move to the S&P 500 chart, when you go back to some of these previous periods, it was undeniable, I think, that there were bubble-like characteristics in terms of the dominance of growth, the persistence of the uptrends, the AI trade just blowing out to the upside. I mean, back here's when SMCI is just plowing up into the 1,000, 1,100, 1,200 kind of range. There's no denying, I would argue at the time, certainly felt like there were bubble-like moments happening. But as long as that trend persists, you have to follow it. I think as a trend follower, I don't have a problem with that. But when you think about the signs that there will be a rotation lower, a spike in the VIX is one of those automatic warning signs that tells you something significant is most likely going to happen. So when we had that spike in the VIX, I think two things: counter trend rally that's going to draw a lot of people in, and number two, further downside. So the issue back here, even as prices were going up and as the S&P is pushing above 5,000, pushing above 5,200, pushing above 5,400, the question was, how much further can we really go given how elevated things are, given the overvaluations by any sort of fundamental metric? Certainly felt like the market was overextended. So the fact that we would just recover and pull back to just about 5,100 and then go right back up to go to 5,700 plus in the seasonally weakest part of the year. I mean, that is absolutely a possibility. I just find that incredibly unlikely. So I like to bet more on likely scenarios that respect market history. And for me, that says we probably have limited upside and a high probability of further downside. That's enough to keep me still pretty defensive here. As we mentioned on yesterday's show, I think this trend line is a great one to watch. I think the 50 days is a great one to watch. I think people maybe misinterpreted my title and our thumbnail yesterday as me turning super bullish. I'm certainly not there yet. I think what I was demonstrating with this chart is what you would need to see, or what I would need to see, to turn way less bearish than I've been here in the last couple of weeks. I'm not seeing enough of that yet, but I think there's a pretty clear roadmap about what we would need to see. The VIX sitting below 20 for a while would certainly be a part of that. So the VIX for now, really following through on that one. All right, let's get back to some of the major averages here. Interest rates overall moving down. The 10-year yield finished today just above 3.8%. 5-year yield around 3.67. The long bond yield still above 4%. At 4.1%. The dollar index essentially flat from yesterday. The commodity complex using the DBC down 0.6%. Gold and silver, the precious metals trade down as well, down 0.8%. Gold, again, still outperforming the S&P and the NASDAQ year to date, outperforming off of the April low. But today down while the equity markets were higher. Crude oil price is actually getting dinged. A little bit of a bounce yesterday, back down below $80 a barrel into today's session. Bitcoin down 2.5%. We're back below 60,000. We're sort of toying with that 60,000 level here, a little above, a little below. I think following through and making progress above there is still an open question, but it's not happening today. Ether prices and some of the other top 10 coins, really mixed, to be honest with you, in the crypto space. All right, let's go to the 11 S&P sectors, and you can see financials, number one, up 1.2%. I did my note for my market update note for my market misbehavior premium members earlier this morning. We focus a little bit on the financial sector, insurance companies. We'll talk about a couple of those here as we continue our market update. But quite a bit of strength in the financial sector in some ways that we've seen before, but in other ways that we have not seen to the degree that we're observing here today or recently. Energy number two up over 0.5%. Technology number three up about 0.5%. 4 of the 11 S&P sectors finished in the red, and only 2 of them meaningfully below the zero level. Communications, services, and consumer discretionary both down just over 0.5% today. Looking at the Magnificent Seven and Friends, our group of leadership names, or former leadership names, I may want to call them. Netflix up over 2% today. NVIDIA up 1.7%. We'll talk a little bit about semiconductors. I think once again, they've sort of always been an area to focus on, but I think especially now because the rally that you've seen, at some point you have to change the label from a counter trend rally to a primary uptrend, and I don't think these charts are there just yet. But they're getting there, and I think I'll be happy to show you what would convince me that there's maybe some more longevity, more sustainability in an uptrend than I would expect. Tesla, however, down over 3%. Alphabet down over 2%. Alphabet out of this group, probably the weakest chart, certainly in the last 6 to 8 weeks. All right, let's continue on looking at some breadth indicators. We did talk about the chart of the S&P already, so I'm going to move into some indicators looking at market breadth. We didn't talk about breadth on yesterday's show, if I remember right. I usually do, but I didn't quite get to it. The McClellan Oscillator, for what it's worth, did push back above the zero level yesterday. We don't formally update the McClellan Oscillator. It's based on closing data, so we actually wait till we have the official closes from exchanges and crunch all the data just to make sure it's accurate, and then we'll update the McClellan Oscillator. So, as of yesterday, we did get back above the zero level for the first time in August. One of the things that's been interesting is that the market has bounced, even though the McClellan Oscillator has been below zero. It's a bit of a surprise, to be honest with you, because the raw advanced decline data actually still looks pretty constructive during the month of August. This is one of those times, July into August, where the major benchmarks, the S&P and the NASDAQ, pulled back, but the breadth data actually remained kind of strong. The McClellan Oscillator, one of the few bearish breadth indicators that did turn bearish in August. For now, though, turning back above the zero level, given what happened today, I would expect that McClellan Oscillator to remain above zero, which means we will start highlighting this back in bullish green. So the breadth starting to improve a little bit. When you think about that chart of the S&P, those red lines, the 50-day, the things we talked about that would signal or maybe confirm an exit from this pullback phase, one of the things I would also want to see, because breadth has remained kind of strong, is an increase in the number of new 52-week highs. There were quite a few at the end of July. Obviously, here in mid-August, very few stocks making new 52-week highs. Of course, very few stocks making new 52-week lows as well. But in a healthy bull market phase, you have an expansion in new highs, because even though the S&P is still pretty far below its own all-time high, about 200 points or so, a lot of individual stocks are actually already very, very close to or making new 52-week highs. So I'd want to see a dramatic improvement, a lot more green bars, a lot of stronger green bars on this particular chart of new 52-week highs. That would be part of the all clear sign that I would be looking for, would be an expansion in new highs that we've not quite seen enough of yet. Last breadth indicator I want to show you, I actually created this chart earlier today just to make a point. I was looking at my morning coffee routine chart list. I look at the Mindful Investor Live chart list as a starting point. Then I look at a bunch of other things, wherever the spirit leads me after that. And I was looking at the bullish percent index for the S&P 500, the bullish percent index for the NASDAQ 100. So this is looking at the S&P 500 members, and out of those 500 stocks, those 500 charts, what percent of them are currently showing a bullish phase based on their point and figure and the point and figure methodology. Currently, as of today's close, it's 56% of the S&P 500. There's actually more bullish readings in the NASDAQ 100, and that actually hasn't been the case for the last month, really. For most of 2024, there have been way more bullish point and figure charts for the S&P than for the NASDAQ, and that speaks to the improvement in breadth that we've seen, certainly after sort of January, February. As we get into March and April, you saw breadth conditions start to improve a bit. So is there a signal there, the fact that there are more bullish charts in the NASDAQ 100 than the S&P? So I put this panel at the bottom, just looking at the spread. So if this is above zero, that means there are more bullish point and figure charts in the NASDAQ than in the S&P. If there's a bunch of red, then it's more S&P than NASDAQ. So this is a great way of just visualizing the relative strength, and it's a relative, I guess, breadth strength, for lack of a better term. And it reminds me of, any sort of spread mechanism where you're looking at the two and just sort of thinking about what that might mean. I think this, for me, this speaks to the leadership, and this speaks to whether the growth stuff that's in the NASDAQ 100, those large cap growth and mega cap growth names, are dominating. Going into March, that certainly was the case. From March through mid-June, this is telling you not the case. This is telling you that way more strength in the S&P 500, a lot of the older economy names, versus the NASDAQ. You see this in particular from mid-February to late March, where the trend was clearly down for the NASDAQ's bullish percent, but clearly up for the S&P. What's happened, though, recently is the S&P went from 70% down to 46%, and now has recovered only to 56%. The NASDAQ was down here in the 60s, went all the way down to 30%, and then now has popped very, very quickly. So that tells you that even though they were both pretty weak in early August, we've had a lot better recoveries in charts like NVIDIA and others, which are back in a bullish point and figure pattern. So it did tilt back to the growthy index, the NASDAQ 100, versus the S&P. It certainly speaks, I think, to me, it speaks to this being above zero means we're probably in that mega cap growth leadership phase. If it's below zero, we're in the value defensive leadership. So the fact that we've gone back above the zero line, the more we stay above the zero line, the more it feels like the return of the Magnificent Seven, the return of the growth trade, and less like values here to stay. So an interesting chart. I think, again, I just set this up earlier and was looking at it. I love the fact that on the Stock Charts platform, we can take these sorts of metrics, create spreads and ratios, and think about what sort of signal those would be in. This is, as an institutional market researcher, which is a hat I used to wear a lot more often. This is the type of work we would do, kind of thought-provoking sort of ideas to look at different comparisons and then monitor them over time. So maybe we'll refer back to this one down the road and see what it can tell us. All right, let's continue on. Just talk briefly about one other chart. I just want to talk about the bond markets. Rates again continuing to come down. The fact that The inflation data essentially came in line today. This was the CPI number, and you had a bit of a choppiness right afterwards, but generally speaking, of course, equities moving higher today. Here's the chart of the 10-year yield, and I just checked as we were during the introduction. The futures market pricing in literally about a 50-50 coin flip between a 25 basis point cut and a 50 basis point cut at the next Fed meeting about 1 month out. So overall, 100%, pricing in a lowering of rates. Is just how much, how quickly. So rates overall, as measured by the 10-year Treasury yield, going down. The TLT and the AG, which are basically this chart flipped upside down, in a clear uptrend. So I think you have rates in a primary downtrend. I don't see any reason to think that changes. We did bounce off of the December and January lows, but overall, the trend in rates is lower. And I would say, as a trend follower, I'm assuming lower rates are the rule until proven otherwise, and I'm not seeing that here just yet. Let's finish off looking at some individual names. Progressive PGR making a new 52-week high today. The insurance group, one of the best performing groups in the Dow industry groups that we track. Progressive is a compelling chart. Allstate is another compelling chart. These are both making new highs. What I like about these charts is that they're breaking out. They've had sort of a sideways period in Allstate, sort of this consolidation phase between around 157 and 175. We've now just broken above there in the last week. For Progressive, sort of in that 200 to 215 range. We did briefly break above there in July, but it was a false breakout. Now we appear to be breaking higher, up over 5% today. So I think the insurance space is interesting. It's a more defensive area within the financial sector, but really speaks to renewed strength in an area of the market that was remarkably strong at the end of last year, beginning of this year. We thought a lot about insurance companies. I remember referring to insurance charts a lot with my premium members of Market Misbehavior because the charts were just strong and outperforming. It's not been the case here in the second quarter, but now as we get into the bulk of the third quarter, you're seeing a renewed upswing in some of those names. So if you've been ignoring that area of the market, I would encourage you to rethink and reconsider. Take another scan at some of the insurance companies. Looking at our Magnificent Seven stocks, I want to highlight just two of them here. I did want to start with Netflix. I think the reason why Netflix is an interesting one, looking at the chart of Meta, there's this great price gap from earlier. It's kind of this price gap from January, February, ended up being resistance that served as support later on. I wanted to highlight this price gap, which is from here. It's so interesting to me. The way that I tend to think about price gaps is I think of them as support and resistance, right? I don't make it any more complicated than that. A lot of people think about, like, what do you do with gaps? I literally draw a rectangle when there's a gap on the chart. You'll find it on some of the charts I show, on the charts that I save on my own, log into different chart lists. Almost always I highlight these gaps as shaded areas because for me, I just think of it as a big support and resistance level, or really a support and resistance range. And it's not surprising to me at all that after we broke out in June and July of this year and then pulled back and failed to hold the breakout level, failed to hold the 50-day moving average, I'm not surprised that we ended up finding eventual support right in the middle of that price gap. So the fact that we've bounced off of that level is pretty impressive. I think Netflix breaking back above the 50-day moving average today is a real cause for excitement. We had a big bearish divergence here going into the July peak, which certainly seemed like a sign of big distribution. It's down, certainly quite a bit off of the high, but now all of a sudden retracing back above there. The more we remain above the 50-day moving average, the more I think this is a constructive chart, the more that the RSI sits above 60. That sort of validates that bullish phase. If and when we get above 700, that would take us to a new high, and it's hard for me to be bearish on Netflix if we're making a new 52-week high. I would tell you that it's worth noting when stocks go into a primary uptrend, divergences are often a great sign of exhaustion in an uptrend. And so looking for that sort of pattern, if we do continue higher, would be meaningful to me. On the downside, it's all about that 580 level. That's the 200-day moving average here. Generally speaking, that's the August low, and that's also that price gap. So you have a confluence of support. That's your downside, I would think, from a technical perspective. Holding that would be key. And now it's all just do we make further upside from there? SMH, the semiconductor ETF, kind of a similar type of thing in terms of going between key levels. I think for the chart of the SMH, I'm looking at something like this. This is the low from April, right around $200 a share. You can see we tagged that around the open about 2 weeks ago. That's when we opened briefly below the 200-day moving average, but closed back above there. That ended up being a really interesting day because it ended up being the low for August so far. Keeping an eye on those sorts of levels, I always pay attention to candle patterns and bar chart behavior, short-term tactical moves around a long-term level. Even though I'm a medium-term, long-term investor, I'm always paying attention to what price does around those key levels, because I think a lot of times that can tell you about the dynamics, the sentiment underlying the stock right about there. So we have clear support at 200. We have the 200-day moving average a little above there around 210. So I think that's your potential area of support. Above current levels, we have the late July peak here around just below 250. You have the 50-day moving average right around that same point. So SMH above 250 to me says most likely return to the all-time high around 280 and potentially much further. You reassess as we test those all-time highs. As long as we hold 200 on the downside, the chart's actually pretty good. So SMH is actually setting up as an interesting, consolidation phase really between two levels. So I think setting alerts at those extremes could be pretty meaningful. Here's an argument, and I'm not going to say this is going to happen, and I may upset some people by sort of laying this out here. But let me tell you another thing that I'm looking at. I hesitate to do this because I don't like when people just do this and then say this is obviously what's going to happen. I don't know what's going to happen. I really don't. And anyone that tells you that they know what's going to happen is lying to you because they don't. No one knows for sure. But what we can do is start to look at some potential movements. And I would say there could be a scenario where all of a sudden this is, a left head and a left shoulder. It's sort of a double-headed head and shoulder, so it's not perfect. But what if this is like that leg higher and then we break below there? This is why that level here, right? This level, this neckline of a potential head and shoulders pattern. It's not a head and shoulders pattern yet, so I can't say it is. But, the bear scenario here is that we're in a counter trend move that eventually stalls out. Right now, if we would stall out, we're almost exactly at the March peak. So a little bit further is about as much as I would be okay with. I'd take this up to the 50-day moving average, but not any more than that. And then you get a leg lower. Breaking 200 is a climactically negative signal, right? I think the bear case for stocks going in a potential September or October low is charts like the SMH would start to look a lot like my pink line that I drew on there. And again, I'm not saying this is going to happen. I'm not saying I know it's going to happen. I'm just saying that is a case that I think watching for and just thinking about what that might look like, what that might do to your portfolio, where you would start to lighten up if you're all long and bulled up here. I think that's a really smart thing to do now while conditions are still kind of okay. That's it for today. Very interested in what you think about that last chart. Drop a comment below and let me know your take on semiconductors here and potential next steps. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.